Welcome to Breaking News to Trading Moves.
Great to be here. We've got quite a task today. We're working through a stack of analyst material, all focused on advanced micro devices, AMD, and their Q3 2025 earnings report.
Right, AMD's latest numbers.
Exactly. And our goal is, well, twofold, really. First, we need to get absolute clarity on the core financials, what actually happened.
The key metrics, yeah.
And second, and maybe more immediately relevant for our listeners, is translating that performance into what it means for the competitive landscape. And crucially, for specific stocks, specific equity tickers that might move because of AMD's results.
Okay, so we're cutting straight to the analysis, focusing on what matters for the markets. And the headline seems pretty clear, right? AMD's Q3 was a beat and raise.
That's the core finding, yes, a beat and raise performance. It wasn't just a minor beat either. The strength really came from two key areas. One, the ongoing strong demand for AI server stuff.
No surprise there.
Not really, no. But also to a noticeable pickup in the personal computer market, the PC market.
Ah, okay. That's maybe a bit more unexpected, given the last couple of years for PCs.
It is, and that foundational statement that beat and raise driven by AI and PCs is really our starting point. When the market first saw this, the positive reaction made sense.
So what were those initial numbers?
Revenue came in around $9.2 billion to $9.25 billion. That was already a bit ahead of what analysts were expecting.
Okay.
But the raise part, what really gave the report momentum, was the guidance for the next quarter, for Q4.
Their outlook.
Right. They projected Q4 revenue between $9.3 billion and $9.9 billion.
And that was also above the street consensus.
Comfortably above, yes. And that strong forward guidance is really what positioned the company well heading into the end of the year. It signals management confidence.
Okay, so that Q4 forecast is key for looking ahead. But let's unpack Q3 first. What actually happened in the quarter that gave them and the analysts that confidence for Q4? What were the mechanics behind the beat?
All right, let's ground ourselves in the actual data from Q3. The overall revenue, like we said, landing between $9.2 and $9.25 billion. Plus, they beat on earnings per share, the EPS beat.
Top and bottom line looking good then.
Exactly. It confirms a certain level of health in their business lines. But, the total number only tells you so much. You really have to look at the individual segment to see where the strength and maybe any weakness came from.
And looking at that breakdown, the powerhouse seems to be the data center segment. That's where the AI and server processor stories live, right?
Absolutely undisputed. Data center is the engine here. The reported revenue for that segment hit $4.3 billion.
Which is a big chunk of the total.
It is substantial, yes. But the growth rate is what really demanded attention.
Okay.
The $4.3 billion represented a 22% increase compared to the same quarter last year. Year-over-year growth of 22%.
22%. Okay. That is a strong growth number, especially for a segment that large.
It really is. Yeah. I'd argue that 22% growth figure is probably the single most important metric in the whole report. Why? Because it validates the multi-year investment AMD has made in the server space.
You mean with their EPYC server CPUs and now the Instinct AI accelerators?
Precisely. Both EPYC and Instinct. When you see a core, high-value segment like data center expanding by more than a fifth year over year, it suggests demand is, pretty deeply entrenched, maybe less susceptible to the usual economic ups and downs we see elsewhere.
That's a good point. Maybe we should clarify that EPYC versus Instinct distinction for a moment. How do they each contribute to that $4.3 billion and that 22% growth? People hear AI, but EPYC is important too.
That's essential context, definitely.
Yeah.
So think of EPYC as the server's brain, the CPU. It handles the general compute tasks, manages the infrastructure. Strong EPYC sales mean AMD is taking share from competitors in traditional data centers and cloud environments.
Okay, the workhorse chip.
Right. Instinct, on the other hand, is the specialized hardware, usually a GPU or a similar accelerator, optimized specifically for training and running those big AI models.
Got it.
So that 22% growth is a mix of both. But the rate of growth, that 22%, strongly implies that adoption of the Instinct accelerators is really picking up pace alongside continued EPYC platform demand. It validates their strategy of offering the whole package, the platform solution, for AI customers.
Okay, so data center is clearly, as you said, firing on all cylinders. But the report also mentioned strength elsewhere, didn't it? Client and gaming.
Yes. Those two segments combined contributed about $4.0 billion in revenue.
Which is almost as much as data center.
Pretty close, yeah. And that's a remarkably strong showing, especially when you think about the roller coaster those segments have been on, the cycles, the inventory issues over the past few years.
Definitely. So what was the detail there?
Well, within that $4 billion, the client segment, that's the part that sells processors for consumer and business PCs like their Ryzen chips.
Right.
The material we looked at explicitly highlighted that the client segment achieved record revenue.
Record revenue. Not just recovery, but a record.
A record. And that's more than just bouncing back from the post-pandemic slump. A record performance suggests real momentum. It probably means they're selling a richer mix of products, higher average selling prices, or ASPs.
Can you expand on that? Why is record revenue so different from just a recovery in units sold?
Sure. When a market's just recovering, maybe volume picks up, but prices might still be soft if there's lingering inventory. Record revenue, though, suggests something more. Either they've gained an enormous amount of market share, which is possible, or, and this seems more likely based on the commentary, the mix of products they're selling has shifted heavily towards the premium end. High margin, more complex processors.
Like the higher-end Ryzen chips.
Exactly. The kind needed for advanced business applications, or maybe for this emerging AI PC category we keep hearing about. When AMD sells one of those high-end Ryzen chips, the average selling price, the ASP, is way higher than a basic chip. So revenue can hit record levels, even if the total number of chips sold isn't an all-time high.
Okay, that makes sense. So record client revenue points towards success in the more profitable premium parts of the PC market, commercial laptops, desktops, that sort of thing.
That seems to be the implication, yes. Capturing share or capitalizing on that premium demand, or likely a bit of both.
All right, so data center strong, client setting records. But it wasn't all positive, was it? There's a weaker spot.
Right. For a balanced view, we have to look at the embedded segment. That part of the business showed a noticeable deceleration. Performance there was down 8% year over year.
Down 8%. Okay, that's a definite contrast to the 22% growth in data center and the record in client.
It is. And that contrast is important for reading the overall market environment. Data center and client are often driven by tech adoption cycles, consumer upgrades, kind of forward-looking things.
Right.
Embedded, though, is more tied to, let's say, longer-term industrial cycles, things that depend on capital spending or CapEx. So that 8% drop acts as a kind of barometer. It flags ongoing softness in certain specific end markets that use embedded computing chips.
What kind of end markets are we talking about when we say embedded compute? Where would you find these chips?
Think about long-cycle industrial stuff. Factory automation, complex robotics, industrial control systems. Projects where companies might delay spending if the economic outlook feels a bit shaky.
Okay, big industrial projects.
Also parts of the automotive sector. Car makers have been dealing with their own inventory issues and the pace of adding complex embedded systems, and also specialized communications gear, like for big telecom networks. If carriers pull back on spending, that hits the embedded segment too.
So the weakness there is like a signal about the health of those specific, often slower-moving, capital-heavy industries.
That's a good way to put it. It's a localized indicator, but often a reliable one for those specific global sectors.
Okay, so let's synthesize this. Massive growth in data center, 22% YoY, record revenue in client, suggesting premium PC strength, but offset somewhat by an 8% decline in the embedded business, pointing to industrial softness.
That's the picture. And that combination of performance, the strength overriding the weakness, brings us back to the forward outlook, the final piece.
The Q4 guidance.
Right. That guidance of $9.3 to $9.9 billion in revenue for Q4 is basically management saying they believe the momentum from AI, Instinct and EPYC, and high-end PCs, Ryzen, isn't just going to continue, but might even accelerate a bit into year-end.
And because that forecast was above what analysts had modeled before the report.
That's why the market called it a beat and raise. They delivered strong Q3 numbers, and they promised continued strength for Q4.
Okay, understanding the numbers themselves is step one, but step two is digging into the why. What are the underlying forces driving these results? Why the 22% data center growth? Why the record client revenue? The material we reviewed highlights three main thematic drivers. Let's start with theme A, the sustained AI buildout.
Yeah, this one is pretty clear from the data center numbers. The analysis points directly to really persistent, strong demand for AMD's Instinct accelerator chips, specifically mentioning the MI350 line, and also continued demand for their EPYC server processors.
So it's not just general server buying, it's specifically AI-related demand.
It seems very much tilted that way. It's evidence that the AI server market is continuing its, well, pretty explosive growth, and AMD is clearly capturing a meaningful piece of that action.
And the material made a specific point about why customers might be buying AMD's AI chips, didn't it? Something about diversification.
Precisely. That's a critical observation. The 22% growth helps validate the thesis that the big cloud providers, the hyperscalers, think Microsoft, Google, Amazon, Meta, are actively strategically diversifying their AI infrastructure.
Meaning they don't want to rely on just one company for all their AI chips.
Exactly. They're looking to move beyond dependence on a single dominant supplier for this really critical compute capability.
Why is that diversification so important for these big players? And why is it important for us as market watchers to track it?
Well, it's strategic for them for a few reasons. First, supply chain security. Relying on one vendor makes you vulnerable if there are manufacturing issues or, geopolitical problems.
Makes sense. Risk reduction.
Second, it gives them negotiation leverage. Having multiple viable options for high-performance chips helps them manage costs better.
Power dynamics.
And third, different AI workloads might actually run better on different types of hardware. So diversification lets them tailor their infrastructure. So when we see strong sales of AMD's MI350 Instinct accelerators alongside their EPYC CPUs, it translates into real large-scale server orders. It shows the biggest tech companies are pursuing this multi-vendor AI strategy seriously. It's not just talk.
So that data center growth isn't just AMD doing well, it reflects a broader strategic shift in the cloud industry itself. If these huge companies are building out infrastructure using AMD parts, that demand feels more structural, more durable.
That's the key idea. It underpins the data center segment's performance, not just for the processors and accelerators, but for all the related components needed to build and connect these complex servers. Memory, networking, power, cooling. The whole ecosystem benefits.
Right. It suggests this isn't just a short-term blip, but part of a fundamental build-out for the next era of computing.
That narrative of strategic diversification definitely adds confidence to the resilience of that 22% growth figure.
Okay, let's shift to theme B, the PC market refresh, and that term we keep hearing, the AI PC. The financials showed record revenue in the client segment, driven by record Ryzen sales.
Yes, and that connection is pivotal. The idea of an AI PC refresh has been talked about a lot, maybe sometimes feeling a bit speculative.
Right. Is it real or just marketing buzz?
Well, AMD reporting record Ryzen sales provides some of the first concrete evidence that this narrative might actually be translating into real sales volume. Ryzen chips are particularly strong in the premium and commercial laptop segments.
Which are the areas expected to adopt AI features first?
Exactly. Those are the segments likely to be the earliest adopters of new capabilities that run directly on the device, using specialized hardware on the chip.
Okay, but let me push back slightly here. How much of this record Ryzen performance is really driven by the new AI PC catalyst versus just a standard, maybe overdue PC replacement cycle finally kicking in after the pandemic lull? Is the material confident this is structural AI demand, not just cyclical noise?
That's a fair question, and it's a critical point. The confidence seems to come from the mix we discussed earlier. Remember, record revenue, not necessarily record units.
Right, the higher average selling prices.
Exactly. That suggests customers aren't just replacing old machines with cheap models. They seem to be genuinely upgrading to machines with newer, higher-margin chips. And these newer chips often include the dedicated neural processing units, or NPUs, that are designed for on-device AI tasks.
So the improved mix, the higher ASPs, are seen as evidence that the desire for AI capability is actually influencing buying decisions, pushing people towards more premium machines.
That's the argument. It suggests users are willing to pay more for hardware that's built to handle local AI tasks effectively.
And if that's true, it validates the idea that people will pay a premium for that capability.
Precisely. And the impact then spreads out. It confirms stronger demand and potential for successful AI laptop upsells across the whole Windows ecosystem. That's good news for the big PC makers, the OEMs, who put these components into the final laptops and desktops.
Because they make more money selling a higher priced machine.
Right. They capture better margins on those premium devices.
So the takeaway here is strong Ryzen sales, especially the record revenue, are being interpreted as validation that the hardware upgrades for on-device AI are a real demand driver, making this more than just a simple replacement cycle.
That seems to be the strong read-through, yes. It looks like a structural upgrade cycle might be starting.
Okay. Now, theme C. We have to revisit the negative point. The softness in industrial and embedded. That 8% year-over-year decline we saw in the financials.
Yes, we can't ignore that. It serves as a useful counterpoint, a reminder that the market isn't universally strong right now.
And this 8% contraction in embedded provides context on broader economic conditions separate from the tech-driven cycles in AI and PCs.
I think so. The 8% drop acts as a negative read-through for those parts of the economy that rely on embedded chip designs, industrial, automotive, maybe some communications infrastructure.
Why is AMD's performance here seen as an indicator for others in that space?
Well, because AMD supplies a pretty wide range of customers in these areas, factory automation, car systems, etc. When a broad supplier like AMD reports a contraction like this in this specific segment, it usually suggests the issue isn't unique to AMD's products.
It's more likely reflecting what their customers are doing.
Exactly. It probably signals that the end customers, the large companies buying these embedded chips for long-term projects, are slowing down their purchases. Maybe due to inventory digestion, maybe pulling back on capital spending.
So it suggests that the generalized softness tied to long-cycle industrial capex hasn't really recovered yet, even while AI and PCs are booming.
That seems to be the case. It highlights a divergence in market health that's worth keeping an eye on.
Okay, so summing up the themes. AI demand is structurally strong and driving diversification. Premium PCs seem to be in a genuine upgrade cycle, potentially fueled by AI features. But large-scale industrial spending, reflected in the embedded segment, is still lagging.
That's the combination of forces. And that combination, anchored by the strength in data center and client, is what determines the consequences for other companies connected to AMD.
All right, now let's translate this. We've got the numbers. We've got the themes driving them. Now, who benefits? Which specific companies are positioned to win based on AMD's strong performance? This is where Q3 success potentially turns into stock momentum.
Exactly. We need to move from the analysis to the specific names. The material we reviewed breaks the winners down into three main categories.
Okay, what's the first category?
Category 1 is the AI server builders and integrators. These are the companies that actually take the chips from AMD, the Instincts and EPYCs, and physically build them into the server racks and systems that end customers deploy.
The ones doing the physical assembly and setup?
Right. The rationale here is direct operational leverage. If AMD is selling more Instinct accelerators and EPYC processors, someone has to build those into servers. This means sustained demand for high-density AI server racks.
And these aren't simple builds, right? These AI systems are complex.
Very complex, often requiring specialized cooling, power delivery, high-speed networking, and this demand also boosts what's called accelerator attachment rates, basically. How often an AI accelerator like Instinct gets included when a customer orders a server. More Instinct sales mean higher attachment rates.
Okay, so who are the specific companies named in the material that benefit from building these AMD-powered AI servers?
The analysis clearly points to two key players here. First, SMCI, that's Supermicro Computer Incorporated.
SMCI, okay.
Yeah.
They're known for getting server hardware out quickly, right? Especially complex stuff.
Exactly. SMCI has a reputation for speed and customization, particularly with high-density, often liquid-cooled systems needed for powerful accelerators like AMD's Instinct. When AMD reports strong data center numbers, it directly validates the market opportunity for SMCI, who are specialists in getting these high-power AI systems deployed fast.
Okay, so SMCI benefits from the sheer volume and complexity. Who else?
The other name mentioned is HPE, which is Hewlett-Packard Enterprise Company.
HPE, more of a traditional enterprise player. How do they benefit?
Well, as companies move their AI projects from just experimenting in the cloud to actually running them in production, sometimes on their own premises for security or data reasons, they often turn to established enterprise partners like HPE.
For building out that private or hybrid AI infrastructure.
Right. So strong AMD data center results mean a healthier pipeline of these potentially high-margin AI infrastructure projects for HPE's enterprise server divisions.
Got it. So SMCI for speed and hyperscale, HPE for enterprise AI deployments. That's category 1. What's category 2?
Category 2 shifts focus to theme B, the PC market. These are the PC OEMs, the original equipment manufacturers, who are the beneficiaries of that AI PC refresh trend.
The company is actually making and selling the laptops and desktops using the record-selling Ryzen chips.
Precisely. This category benefits directly from that record client segment revenue and the better Ryzen product mix we talked about. That combination points to rising demand for higher-end Windows PCs built around those newer AMD processors.
And the opportunity there is the upsell, right? Convincing customers to buy a more expensive machine because it has AI capabilities powered by those Ryzen chips.
That's the core idea. If the market is demanding better, faster processors designed for new AI tasks, think faster video editing, coding assistance, things like that. It pushes consumers and businesses towards premium devices. The OEMs capture the revenue and hopefully better margins on those higher-priced machines.
So which PC makers are highlighted as benefiting from this trend?
The analysis names two big established players, Dell Technologies Incorporated,
DLL.
and HPQ, which is HP
So
Incorporated.
DLL and HPQ, the two giants of the Windows PC world.
Right. DL, for instance, has a very strong position in the commercial PC market. Businesses are often the first to adopt new tech and pay premiums for productivity gains. So higher Ryzen volumes, especially the premium ones, should directly boost revenue and potentially profit margins for DL's main PC division, their Client Solutions Group.
Makes sense. And HPQ.
HPQ benefits from the same overall resurgence in the Windows ecosystem driven by these faster chips. It supports their focus on premium laptops, particularly for smaller businesses or creative professionals who might really value that on-device AI performance.
Okay, so Dell and HPQ win from the stronger PC market, especially the premium end driven by Ryzen. Now, what's the third category of winners?
Category 3 gets into the crucial components needed inside those powerful servers and potentially high-end PCs, memory and storage for AI.
Ah, the guts of the machine.
Exactly. This is a supply chain benefit. The rationale is pretty technical but clear. AI accelerators like Instinct and powerful server CPUs like APYC are incredibly data hungry.
They need to process huge amounts of information very quickly.
Right. To do that without bottlenecks, they require massive amounts of very fast memory, specifically high bandwidth memory, or HBM. And they also need extremely fast, low latency storage solutions, like high-end solid-state drives, SSDs.
Can you quickly explain HBM again? Why is it different and essential for AI?
Sure. Unlike regular DRAM memory sticks you might put in a desktop, HBM involves stacking memory chips vertically, right next to the main processor or accelerator chip on the same package.
So they're physically much closer.
Much closer. This drastically cuts down the time it takes to get data to the processor, latency, and massively increases the amount of data that can be moved per second, bandwidth. For the enormous models used in AI, this high bandwidth isn't just nice to have. It's basically essential for the system to run efficiently. Otherwise, the expensive accelerator sits waiting for data.
Okay, so strong demand for AMD's AI chips automatically creates strong demand for HBM.
Yes, and also for very fast storage. It creates this positive cycle in the supply chain. This technical need lifts the overall bit demand, the total amount of memory and storage capacity needed globally.
And because these are specialized high-performance components.
It improves the pricing power for the companies that make them. HBM and the fastest enterprise SSDs aren't commodity parts. This specialized technical demand helps support prices for the suppliers.
So which memory and storage companies are named as benefiting?
The analysis identifies two key players here. MU, which is Micron Technology Incorporated.
MU Micron, a major memory maker.
Yes. MU is a primary provider of DRAM and NAND flash, and they've been investing heavily in scaling up production of HBM, which is critical for systems using AMD's Instinct or competitors' accelerators. Strong AI server demand, regardless of who makes the main chip, directly supports MU's potential for revenue growth and better pricing.
Okay, MU for memory. Who else?
The other name is WDC, Western Digital Corporation.
WDC, Western Digital, known more for storage, hard drives, and SSDs.
Right. While they're more focused on storage than memory, the need for extremely fast SSDs and AI servers and even high-end workstations is crucial. Handling the massive input-output operations of an AI training cluster requires top-tier flash storage, so the AI boom drives demand for WDC's high-performance enterprise SSD products.
Okay, so the winners are SMCI and HPE building the servers, DEL and HPQ selling the AI PCs, and MU and WDC providing the critical memory and storage components inside. A whole ecosystem lift.
That's the picture painted by the analysis, yes. Success in data center and client creates demand and potentially better pricing power across these related areas.
Okay, we've looked at the winners, but every action has a reaction, right? AMD's strong quarter likely didn't happen in a vacuum. Their gains probably mean increased pressure on competitors. So let's look at the flip side, the identified loser categories.
Absolutely. It's rare for one company to gain significant ground without others feeling the pinch. The first and most direct category impacted is obviously CPU competitors.
Companies that make competing processors.
Exactly. The report showed AMD gaining traction in both the high-margin server market with EPYC and the high-end client PC chip space with Ryzen.
So if AMD reported 22% growth in data center and record revenue in client, it stands to reason they took that share from somewhere or at least put pressure on incumbents.
That's the clear rationale, yes. AMD's documented gains, especially EPYC winning deals with cloud providers and Ryzen doing well in premium PCs, put immediate direct pressure on the product roadmaps and pricing strategies of the established players.
How does that pressure manifest?
Well, it can force competitors to potentially lower prices on some of their own chips to stay competitive. Or it might force them to spend more on R&D, maybe accelerate their own product launches just to keep up or defend their existing customer base. It affects both their top line and their expenses.
Okay, so which specific CPU competitors does the analysis identify as feeling this heat?
The material names two primary competitors here. INTC, which is Intel Corporation.
INTC Intel, the longtime incumbent in both servers and PCs.
Right. For INTC, strong EPYC sales from AMD directly challenge their Xeon server processor business, particularly in those large cloud deals where AMD has been making steady inroads. And similarly, the record Ryzen revenue puts pressure on INTC's core processors in the premium laptop and desktop markets.
Okay, so INTC feels it on both fronts. Who else?
The other name mentioned is QCOM, Qualcomm Incorporated.
QCOM, Qualcomm. They're more known for phone chips, aren't they?
Historically, yes.
Mm-hmm.
But QCM has been making a very aggressive push into the PC market with their Snapdragon chips, using ARM-based architecture, aiming specifically at that AI PC opportunity.
Trying to challenge the traditional x86 dominance of Intel and AMD.
Exactly. So AMD reporting record client revenue with its x86 Ryzen chips suggests that the established ecosystem is defending its territory quite effectively, at least for now. This could potentially limit the immediate market share gains for newer entrants like QCM trying to break into that lucrative AI PC space. It makes their path harder.
Got it. So INTC faces direct competition. QCM faces a tougher barrier to entry. That's category 1. What's the second category of losers?
Category 2 is a bit more subtle. It's described as pressure on AI accelerator incumbent sentiment. This isn't necessarily about immediate lost sales, but more about how investors perceive the long-term competitive landscape and how that affects valuations.
Okay, affecting the story around the dominant player.
Precisely. The analysis argues that seeing a stronger, credible trajectory for AMD's AI chips specifically, the MI350 gaining real traction and appearing on cloud provider roadmaps, introduces tangible competition into a market that, until recently, was often viewed as being dominated by one main supplier, facing supply constraints.
So the perception was one company had a near monopoly on the best AI chips.
Or at least a very, very dominant position with limited alternatives. Now, what happens to the valuation of that dominant player when a viable competitor like AMD proves it can execute and win big deals?
Their perceived dominance might seem less absolute.
Exactly. It starts to compress what the analysis calls the scarcity premium.
Scarcity premium, can you define that?
Sure. It's the extra valuation multiple investors might put on a company's stock because they believe the company is the only viable source for something critically important, and in high demand in this case, top-tier AI compute. When a strong alternative like AMD emerges and proves itself, it casts doubt on the incumbent's ability to maintain that near monopoly on future growth. Investors might start worrying about multiple compression.
Meaning the stock price might not command as high a PE ratio or other valuation metric, even if earnings are still strong.
That's the potential risk, yes. Even if the market leader is still selling everything they can make, the assumption of perpetual, uncontested dominance gets questioned when AMD posts 22% data center growth fueled by AI wins. The risk isn't just losing one specific deal today. It's about investors reassessing how much of the total future market the incumbent can realistically capture long-term.
Okay, that makes sense. It's about the long-term narrative and valuation ceiling. Which companies are identified as feeling this sentiment pressure?
The primary target of this sentiment pressure is clearly NVIDIA Corporation.
NVIDIA, the undisputed leader in AI accelerators currently.
Yes. AMD's success serves as confirmation that the hyperscalers' diversification strategy is real, and that puts pressure on the scarcity premium that's been a factor in NVIDIA's valuation.
Anyone else mentioned in this context?
The analysis also includes AVGO, Broadcom Incorporated.
AVGO, Broadcom, how do they fit in? They don't make the main AI GPUs like NVIDIA or AMD.
No, but AVGO plays a huge role in other critical parts of the AI infrastructure. They are leaders in custom AI chips, ASICs for some cloud providers, and critically, they provide the high-speed networking components, switches, network interface cards needed to connect thousands of these accelerators together in massive clusters.
Ah, the plumbing of the AI data center.
Right, so if AMD becomes a stronger end-to-end competitor, potentially offering platform solutions that bundle compute and maybe influence networking choices, it creates a more complex competitive environment for AVGO's networking and custom silicon businesses within that AI ecosystem.
Okay, so NVDA feels the direct accelerator competition sentiment. AVGO feels pressure on the surrounding infrastructure and custom chip business. Now, category 3 of the losers. We have to come back to that weak spot in AMD's report.
Yes, Category 3 circles back to the industrial and embedded chip suppliers. These are companies that might feel a negative read-through from AMD's localized weakness in their embedded segment.
Because AMD's 8% drop there might signal broader issues.
That's the rationale. The explicit 8% year-over-year decline in AMD's embedded business is seen as a potential warning sign for overall demand in the industrial and automotive compute spaces that rely on these long-cycle embedded chip designs.
What's the financial link again? If AMD is seeing weakness, why does that affect others?
The thinking is, if a major diversified supplier like AMD is reporting a demand contraction here, the root cause is likely broader than just AMD-specific products. It probably points to macroeconomic factors, maybe a general slowdown in industrial capital spending, or ongoing inventory adjustments among the customers who buy these types of chips.
So other companies that are more focused on just those industrial or automotive markets might be facing similar or maybe even tougher conditions.
That's the concern. AMD's exposure to embedded is significant, but for some other chip makers, it's their core business. So AMD's number acts as a potential leading indicator for the health of that entire sector.
Okay, which specific industrial and embedded chip suppliers are named in the material as potentially facing these headwinds based on AMD's report?
The analysis points to TXN, Texas Instruments Incorporated.
TXN, Texas Instruments, a giant in analog and embedded processing.
Yes, heavily exposed to industrial and automotive markets.
Yeah.
And the other name is NXPI, NXP Semiconductors, NV.
NXPI, NXP, also a major player, especially strong in automotive.
It's exactly. Both TXN and NXPI have substantial business tied directly to industrial controls, automotive systems, and related communications infrastructure. Seeing AMD report a decline in their comparable segment acts as a cautionary flag for this whole group. It suggests that the cyclical downturn in these specific capital-intensive markets might be lingering, justifying a more cautious outlook for TXN and NXPI until there's clearer evidence of a recovery in industrial spending.
So it confirms that the rebound in those industrial capex cycles seems further off, even as AI and PCs show strength.
All right, so we've covered the financials, the driving themes, the winners getting a lift, and the losers feeling the pressure. Now, let's boil this down. What are the key takeaways from the analysis for someone actually tracking the markets and potentially trading based on this AMD report?
The material provided 3 specific trading takeaways. Synthesizing the analysis, what's the first one?
The first takeaway focuses on momentum and potential buying opportunities. It states that momentum names with AMD leverage, thinking specifically about those AI server and memory stocks we identified as winners, should stay in play on pullbacks.
Meaning, if those stocks dip, it might be an opportunity.
That's the suggestion. The view seems to be that the underlying growth story in AI, which AMD's report helps confirm, is strong enough that temporary dips in related stocks, like SMCI or MU, could be seen by market participants as chances to get involved, assuming that core AI build-out thesis remains intact.
Okay, so stick with the AI-related winners on weakness. What's the second trading takeaway?
The second one is about managing the competitive dynamics. It advises market participants to watch relative value pairs in CPUs and accelerators as these competitive narratives unfold.
Relative value pairs, what does that mean in practice?
It means don't just look at AMD in isolation. Compare it directly against its main competitors. For example, actively compare the performance and valuation of AMD versus INTC in the CPU space, or AMD versus NVDA in the AI accelerator space.
So if AMD is gaining ground, you watch to see if its valuation goes up relative to Intel's or if Intel's comes down.
Exactly. You monitor if the market is fully reflecting the changing competitive landscape and the relative prices of these stocks. Is the loser stock being penalized appropriately as the winner gains traction? It's about trading the relationship between the competitors based on who seems to be winning the current battle.
That keeps the focus dynamic on the actual market share fight.
Got it. And the third takeaway.
The third takeaway is more about monitoring future execution and external factors. It simply says, continue to track the execution of AMD's Q4 guidance very closely.
Making sure they deliver on that $9.3 to $9.9 billion promise.
Right. Meeting or beating that guidance would reinforce the strength seen in Q3. Missing it would obviously raise questions. And alongside that, the analysis specifically mentions keeping an eye on any further updates about China-compliant AI parts.
The regulatory angle. Making sure they can still sell effectively into the Chinese market given export controls. Correct. Navigating those regulations successfully is an important variable for AMD's future revenue and competitive stance in a key geographic market. It's an external factor that needs ongoing attention.
Okay, so 1. Buy AI winners on dips. 2. Trade relative value between competitors. 3. Watch Q4 execution and China regulatory news. That seems like a solid framework based on the report.
It covers the immediate implications and the forward-looking monitoring points identified in the material.
Now, before we wrap up, we wanted to leave you, the listener, with one final thought to mull over. Something that builds on the themes we discussed, particularly that tension between the need for AI diversification and the current market concentration.
Right. We established that the big cloud players, the hyperscalers, are actively diversifying their AI chip suppliers. Right now, that might be seen as a strategic preference driven by supply security, cost leverage, maybe performance nuances.
Okay, a strategic choice.
But the question to consider is this. How quickly could that demand for AI diversification shift from being just a strategic preference to becoming an absolute supply necessity?
What do you mean by a necessity?
Well, think about the sheer projected growth in demand for AI compute globally. If that demand continues to grow exponentially, as many predict, could we reach a point where the current dominant supplier, even running at full capacity, simply cannot produce enough chips to meet the total market demand on their own?
So a situation where the hyperscalers need AMD and potentially others to ramp up significantly just to get the total number of AI accelerators required to run their businesses.
Exactly. If the market gets so big, so fast, that relying on multiple high-performance suppliers becomes unavoidable simply to meet basic capacity needs, what does that accelerated timeline mean, especially for the current incumbents, like NVIDIA?
Does it accelerate the erosion of that scarcity premium we talked about? Or does it maybe just mean the pie is growing so fast everyone benefits? Or is the market already pricing in this need for multiple suppliers?
Those are the questions. That potential shift from diversification as a choice to diversification as a necessity, and the timeline for that shift, is the longer-term dynamic underpinning reports like AMD's Q3 results. It's about the future balance of power in this critical market.
Definitely something to think about as this AI build-out continues to unfold. A very compelling dynamic.
Well, thank you for joining us for this focused review of the material surrounding AMD's Q3 2025 performance.
And just a reminder, this is not financial advice or a buy or sell recommendation. This is purely the opinion of the author of the analyzed material.